Within the retail lending industry, the small self-employed customer or the MSME segment is especially underserved. Less than a fifth of the demand for this segment is actually catered to, and the remaining just goes a begging. Okay, so this is a vast opportunity. And finally, India has the world's largest private gold holding. Only 7% of this gold is pledged, half of it to the formal segment and half to the informal segment. So the opportunities for lending against gold include formalizing the informal as well as expanding the overall pie. So this is what the environment looks like through our eyes, and this is the environment that is the wind beneath our wings as we cater to the needs of the small self-employed segment. This is the set of products that we have at Fedfina, which we use to cater to this segment. We have mortgage loans, gold loans, and unsecured loans. We do mortgage loans in two ways. Up to 25 lakh rupees, we use the assessed income method of underwriting, which means we go to the customer's premises. He does not give us any proof of his income. We spend time assessing his turnover, his income, and fashion a loan amount for him. Beyond 25 lakh rupees, we look for some proofs of his income and turnover, whether it's direct or surrogate, and do a loan. Obviously, the payoff for having to assess the individual's income is that we get a higher yield on those kind of loans. Our gold loans are distributed through our branches, an average ticket size of 1 lakh rupees. Okay. Our unsecured loans have an average ticket size of 23 lakh rupees. These are customers who have P&Ls, balance sheets, tax returns, but what they don't have is collateral to provide us, which is why they give us yields of over 17%. So these are the sets of different products that we have, which we use to cater to the working capital needs of the self-employed segment in the country. A few words about our risk approach. We are largely a secured business. 86% of our loans are secured. We are diversified. Our largest state accounts for only 19% of our portfolio. And this is Maharashtra, and this 19% is across gold, mortgage, and unsecured, which means that there is no single product market segment which accounts for a double-digit portion of our business. We are granular. You can see that our ticket size for the working capital business is 22, 23 lakh rupees. For the gold loan business is 1 lakh rupee. We are conservative, and you can see that our retail GNPA has been hovering at the 1.5% mark and 1.8 as of June. And finally, we are prudent. You can see that over the past 3 years, our spread has gone up from 7.2% to 8%, whereas our our cost of credit has come down from 1.5 to 0.6%. As a consequence, the risk-adjusted spread has gone up from 5.7 to 7.4%. That means our operations are a lot more profitable, or our risk-taking has gotten a lot better over the past 3 years. This is a phygital distribution model. There are 4 forms of distribution that we have. First up, we have branches, 584 of them in 17 states and union territories across the country. Okay, and this is the spread of branches. You can see them on the map. Secondly, we have over 1,800 channel partners who help originate loans for us. The third form of distribution that we have is a doorstep lending model, especially for gold loans, where customers who have inhibitions walking into our branches, we go to their homes and their premises and do the loan at their doorstep. And finally, digital distribution. Over 60% of our customers are present on our digital channels, and about 40% of our transactions actually happen digitally. Okay, so that's an important form of distribution for us. You can see that over the past 4 years, we've been taking up our branch presence from 359 as of FY21 to 584 as of June 23. So we've been scaling up our presence. Our cost of borrowing has been a huge source of advantage for us. You see in the chart on the bottom right corner, our cost of borrowing last year was 7.8%. This was when we were rated AA minus. We've subsequently received a rating upgrade. So even at AA minus, our cost of borrowing was 7.8% versus 8.8 for AA plus kind of companies. So this is an important one. Our asset liability management has the advantage that the gold loan portfolio is an extremely short tenor portfolio. So as a consequence, the tenor of our borrowing is far longer than the maturity of our assets. So our ALM is positive right from the first bucket itself. We have a diversified set of lenders. Every private sector and public sector bank lends to us, and they have deep lines that on Fedfina that we can avail of. All these advantages have translated into a reasonable set of financial metrics. You can see the trajectory of our AUM growth. We were at 4,800 crores in March 21, 6,200 in March 22, 9,100 in March 23, 9,400 in June 23. So our AUM has been consistently scaling up. We've preserved and have actually improved our yields over the past few years. Our net worth has been going up as profits have increased. Our profits have increased from 62 crore rupees in 21 to 180 crore rupees in 23, and June 23 was 54 crore rupees. So it's an increasing trajectory of profitability. And finally, our return on equity has gone up from 8.1% in 21 to 14.4% in 23 on the back of increased ROAs, return on our assets. So all in all, we've been scaling up and becoming more profitable with each passing year. What does the future hold? We will continue to scale up in a calibrated fashion. We will acquire our customers in our branches and focus on optimizing the performance of our branch network. If we do this, then the AUM per branch will keep increasing, but the cost will not rise in the same proportion. So therefore, there is operating leverage to be had, and which will result in greater profitability. There have been a slew of technology initiatives over the past couple of years, which should make us more efficient. So that, coupled with the operating leverage that we have, should help us deliver consistent and calibrated industry-leading returns over the coming years. So that, in a nutshell, is the Fedfina story. Happy to take any questions you may have here.
Hi, I'm Saloni Kothari from BQ Prime. First thing I wanted to understand is what will your capital structure look like post the IPO, as far as True North is concerned, and even Federal Bank, are they like selling the entire? I don't think so. They're selling the entire stake, right? So can you just help me understand that?
Sorry. So we are raising 600 crore rupees of primary. There's 492 secondary in the IPO. Now, post the IPO at the highest price band, Federal Bank will have about 61% of the company. True North will have about 8.5%. And about 31% will be the new shareholders who will come in post the IPO. So that's what the capital structure is going to look like. Yeah.
My second question is that you obviously have like a major contribution from the MSME and the gold loan side, right?
Mm-hmm.
So could you help like understand the geographies, especially MSME financing? Technically, if we talk about, because you have an opportunity there, but there are also concerns related to how they struggle with the financing and everything, right?
Mm-hmm.
So I just wanted to understand the geographies, like where do you exactly get these demands from? Any particular, geographical area that from where the MSME demand is coming from, something like that?
So I presented our geography slide, our distribution slide. We are present in 17 states, okay? And we have branches in all these states. each of our branches canvasses business around in the neighborhoods, in the business district, and originates customers. Each branch is tasked with originating 10 loans every month. That is the standard of performance that they have. So willy-nilly, the demand will come from where we open our branches. Now, before we open our branches, there's a process of estimating industrial activity in the neighborhoods, right, and looking at, what competition is doing, what the performance of the portfolio is there, which you get from the credit bureau. So using a combination of these inputs, we open branches. And wherever we open our branches, it's the neighborhood that we canvas business from and build our portfolio.
So what percentage of it is from the MSME and from gold in your
Oh, okay. The gold loan business is about 32% of our overall portfolio. Okay. And that business is distributed through our branches. The rest of our business is MSMEs, and all our customers are MSMEs or priority sector. And yeah.
Hello. Yeah, here.
Hi.
Yeah, Nilesh Wagela from Mumbai Samachar. You are also providing this doorstep gold loan. So one question is that what means gold is very volatile commodity nowadays. So how you means deal with that? And secondly, in this doorstep gold, you are also disbursing immediately, instant. So from the safety point of view, you are taking all the cares for transferring the gold, but this instant disbursal, I just elaborate about it. Means it is a very special kind of skill required for assessing the gold and its valuation and all.
Correct. So valuing the gold is a skill, and that's a manual activity. In each of our branches, we have two people who assay the gold and confirm the purity or the caratage of the gold that is there. Now, the way the doorstep gold loan process works is that leads are procured either online or through telecalling. And there's a salesperson who visits, explains the product to the customer, and confirms the terms of the loan. So after that, there are two people who visit the customer, who value the gold and put it in a safe and bring it back. The safe actually is GPS enabled. So even if it miscarries, you're able to trace it. So if somebody runs away, for instance, you know where the safe is, so that kind of stuff. Now, once you assay the gold, it's the same process as we do in the branch. So you know that this ornament is worth, say, 1 lakh rupees, and the customer wants 60,000 rupees. That 60,000 rupees, there's an online transfer. So the customer then gets service without having to venture out of home. Now, this is especially useful for a lot of customers who do not want to come to the branch and be seen as pawning the gold. Okay, because unlike, let's say, borrowing against property, borrowing against gold still carries some social stigma, which is rapidly withering away, but there are customers who still associate with that. So that's the doorstep gold loan process. And it's an extremely important initiative for us, and it is used to build our AUM. It is also an initiative to support our distribution strategy, where our branch, instead of originating customers from a small periphery around the branches, can spread its wings further. So that's the importance of doorstep gold loans for us. The second question that you asked is about the fact that the prices of gold are volatile. They go up and down. Now, we run the gold loan business like a margin finance business. It's like lending against shares, for instance. Prices of shares also go up and down the way gold does. With the difference that the only difference is that people who have shares see it like a financial asset. So if the price goes, you can sell the share, there's no attachment to it. Whereas gold, there is sentimental attachment because it's got passed down through generations, and there are emotional kind of reasons why that specific ornament is valued. So we do a margin call when there's an 88% LTV and give the customer some time to regularize. So a 2-week time, the customer gives us more cash or more collateral. Otherwise, we auction the gold. Our auction processes have been in place since 2011, and we have established counterparties who buy gold. So that process is reasonably in place.
Okay, one more question that now hallmark is compulsory. So while in this kind of transaction, does it require compulsorily?
No, it doesn't. In fact, lending against bullion is prohibited by the Reserve Bank of India. So the only acceptable collateral is gold ornaments. So you have earrings or nose studs or something that come, and you need to find the weight of the gold in that and assess the purity. There is no hallmarking in the ornament that there is. Yeah, and a lot of gold is old ancestral gold. That's just the way it is.
Thank you.
Thank you.
Hello, sir.
Sorry, I'll just add one point to what Anil said. See, the product is convenience. The product is not the loan, right? So doorstep model is an opportunity to expand the universe to people like us and make credit convenient to them. Thank you.
Sir, I have a question for you. What is
Sir.
the synergy between Fedfina and Fedbank? If you can throw some light on that.
So the Federal Bank is an investor. It is a parent. Okay, and we derive a lot of advantages from being a subsidiary of Federal Bank. I've highlighted the impact that it has on our cost of borrowings, where despite being AA minus for most of last year, we were punching fairly above our weight in terms of access and the cost of borrowing that we have. Now, we are an NBFC and our target market is the small self-employed customer. Federal Bank is a private sector bank and their target market is a typical private sector bank target market, which is the established self-employed customer, the salaried customer, some NRI customers, and they have a significant presence in Kerala. So, customers in Kerala are their target market. So the target markets are distinct, and if anything, we supplement this rather than compete. Now, in terms of operating model, Sham and Ashutosh sit on our board and they help optimize the strategy of Fedfina. Okay, and it's a distinct company with a distinct strategy really that there is as far as market approach is concerned.
And how do you differentiate yourself in servicing compared to Fedbank?
So while some of the products may be the same, the way we offer it and the target market that we offer it to is different. So the analogy is Four Seasons has a restaurant and there's a restaurant probably next door, but they cater to different target markets and different client. Our gold loans, for instance, have an average ticket size of 1 lakh rupee and the weighted average yield is about 17.5, 1775. Federal Bank has an average ticket size of about 3.5 lakh rupees. Their average yield is about 10.1%. So it's a different kind of customers that we have. The second thing is that you look at mortgage loans, we do small loan against property with an average yield of about 17%. Federal Bank does it with an average yield of 9%. So they do much larger loans. So even in the same product, the different target market and the different value proposition that we offer it to. Ganesh alluded to value. Okay, the value that our gold loan offers is convenience. So in half an hour, we take the customer can walk in and out. So the value proposition is different from Federal Bank and different from our Fedfina.
So I'll just add a few more points to that. What Federal Bank gives us is parentage, pedigree, culture, values, right? The whole foundation we have built is a foundation built on longevity. We intend to be in the country for a few decades, not a few years. And that kind of governance helps. Also, for a NBFC, the raw material is borrowings. It gives us a very solid, low-cost foundation for our raw material, which is the cost of funds, which helps us lend more sensibly and to segments which are perhaps a little lesser risk than where the peer group might be lending. Thank you.
On branch network aspect, how do you have synergy with Fed Bank? Means you are using their branches and they are using your branches, something like that?
No, distinct branches once again. Federal Bank has 1,300 branches, about 600 in Kerala, 650, 700 outside Kerala. We have now 584 branches all outside Kerala. So in terms of geographical overlap, it is minimal. in terms of customer segment overlap also, it is minimal. So if anything, the two complement each other and we don't, use each other's branches.
Thank you and wish you all the best.
Thank you very much, sir.
So this is Gopika from Mint.
Hi.
Hi. I just want to understand how does your cost of funds get impacted by the recent RBI changes to the risk weights?
Sure. So we are rated now AA plus. Okay. And a AA plus company has a risk weight of, I think, 30% as far as banks are concerned. Now, my reading is that if the risk weight goes up by 25 percentage points, that 30% risk weight becomes a 55% risk weight. So it's up to the bank to price it in appropriately. So we've been in conversation with banks, including our parent, to see how it impacts. There is no clarity on that yet, but it is fair to say that there will be some increase in the cost of borrowing. Exactly how much isn't dimensioned yet, but I'll request Ganesh to add to that.
Thank you, Anil. See, if you look at the intent of what RBI seems to be doing by virtue of yesterday's circular, is I think they have a concern primarily with unsecured retail consumer credit, right? And that's where, when Anil shared the presentation, we are primarily a secured collateral-backed lender, right? So that's one. So 87% of our loan book is secured, either by movable property or by gold. And if you see the circular, there are some relaxations encapsulated or exclusions for, collateral-based lending there. The second thing is, we are not in the business of retail personal loans. We are in the business of MSME business loans, right? So that also, if you see the circular, and while the circular is brief, our initial understanding is perhaps, the RBI stringency pertains to an area which is different from where the segment we are in. Obviously, we'll have to understand, have conversations to understand the impact more. Even from a bank borrowing, our understanding, and we are just trying to flesh out that understanding, is that if our portfolio is primarily PSL and a bank is lending to us, we are evaluating if there are relaxations in terms of risk weightage for such kind of lending by banks to NBFCs. Thank you.
But you also have a small portion of unsecured book, right? Okay, so on that also you will have to, will there be any capital, what would be the sort of capital impact because of that?
So, sorry.
Go ahead.
So as I said, if you look at the circular, seems to target unsecured retail credit. Our initial reading, of course, it's personal to us, it suggests that for unsecured MSME business loans, which is the segment we are in, perhaps that is not the intent of the circular. But as I said, obviously, we will have to gather more wisdom around it. But as of now, we are not very unduly worried about what is happening.
Right. So we've seen that most of the shares have taken a beating today because of this circular, and the IPO also comes at a time when the circular has been issued. Do you see the sentiment taking a hit because of what has happened, because it's affecting across the sector?
So we are in the business for the long term. Okay. The analogy is this: people who borrow to finance their home, okay, borrow for the long term. They retain a loan for 8 years or 10 years. In this period, the interest rate cycle goes up and comes down. Okay. And over a 7-8 year period, it kind of nets out. There are periods of high interest, low interest. Similarly, we are a going concern. We are in business for the long term. So there will be things that happen, okay, and which we will take in our stride. My take is that what the RBI has done is to put guardrails in place for sustainable growth of credit to various segments, so that growth doesn't happen in fits and starts, and the system does not have to bear the brunt of excesses by any player or set of players. So I think that is the RBI's intent. Now, the system will react so as to accommodate this kind of change that there is. Also, I believe that people who are looking at FedFina are long-term investors, or that is at least the kind of community we hope to attract. So short-term sentiment, I think people will absorb.
Thank you.
So I'll just maybe add one small thing to that. See, our vision is a little different. We are trying to give credit to the emerging India, the Atmanirbhar India, right? And we believe that we will have people who associate with our vision, who will participate in this long journey with us to spawn a new generation of entrepreneurs in the country. Thank you.
This is Lalitindu Mishra from the Hindu.
Hey.
I saw you saw a map saying that you are present in 17 states and union territories. Still, you are not present in a large sphere part of India. What made you to not venture there?
So it's a journey. In 2018, we were present only in 4 southern states. After that, we've been adding branches and growing brick by brick. We've begun to fan out westwards and northwards. We've been growing contiguously in that we choose an area, our presence of branches gets denser, then we go to the adjacent geography. That's how we keep growing. So you're right, there's a huge runway for growth in India. And the part of India that we are not present in is significantly underserved. And hopefully we will cover that in the future.
Any idea when you'll go pan-India?
So our branch network has multiplied about 5 times in 5 years. Okay. And that pace of growth, we could take some time before we cover the entire country. The largest population in the world, 7th largest country, will take some covering. So we will achieve that in even time.
Thank you.
Thanks.
Hello. Sir, I'm Jayagumar here. See, my question is, what is your plan or strategy to compete with the leading NBFCs like Muthoot Finance, then Manappuram Finance? How you can compete with?
So first up, we are in the business of empowering emerging India with easy access to loans, which means we offer loans to the small self-employed customer. We do this in 3 ways. We do it against pledge of gold, against property, and unsecured. So that's the wide set of products that we have. There are several NBFCs in the country, including the ones that you named, which have their own niche. But you look at it through our lens, and I mentioned this in the presentation, the target market that we are catering to is significantly underserved. Only 20% of the demand is catered to, and the remaining just is underserved. The opportunities are just in placing the right product in front of the customer and giving him an opportunity to purchase. That really is what we need to do. You mentioned gold loans. The opportunities in gold loans is formalizing the informal. Okay. Half the gold loans in this country are by informal lenders such as pawnbrokers and stuff, which informal lending practices and much higher interest rates. To bring them within the ambit of formal finance actually will double the AUM at this point in time. And over and above this is the opportunity to grow the overall industry AUM as borrowing against gold becomes more mainstream. We are seeing, brand ambassadors of leading gold loan companies, like you mentioned, who are actually advocating this kind of a change in the target market.
So I'll just add something to what you said. See, traditionally, the gold loans have been serviced by branch-focused models. You need a loan, go to the branch. Our model is a combination of that, but the bigger vision is, you need a loan, we will come to you. So it's a slightly different construct. Also, our vision is, today, as we articulated on the Doorstep model, we want to destigmatize. Unfortunately, today, taking loan against jewelry of mother, wife, daughter, there is a stigma associated, right? We are trying to destigmatize. Today, all Indians, including all of us, have gold lying idle in our safes and cupboards and lockers. We are just trying to help the ordinary Indians harness the power of that by giving them an opportunity to leverage that, have ready liquidity, so that they can, avail of opportunities as they arise. Thank you.
And what about the automobile sector, sir? What about the your loan portfolio? How much you are given to automobile sector?
So, like our product slide said, we have mortgage loans, lending against gold and unsecured loans. We are not present in vehicle loans at this point in time.
Thank you.
Thank you.
There is a question from the online virtual attendees. This question is from Gitanjali Khedia from SP Tulsian Investment Advisory Services Limited. Why has the net NPA of 1.8% not reduced in the recent past 15 months, even after the pandemic stress is over?
Right. So, the NPAs in our business come from different products, mortgages, as well as gold loans. For gold loans, what we do is that as the customer crosses 90 days past due, we give him a fair amount of time to regularize. And in 60 days after that, he either gives us cash or more collateral and the loan gets regular. Otherwise, we auction the gold. That is one part of the increase in NPA. The second part of the increase in NPA is explained by the fact that our percentage of assets off book has increased. Okay, we used to be at 8% of our assets off book, that has increased to about 12%. So what that means is that your denominator reduces and your NPA simply stays. So that has the impact of actually increasing the NPA because the denominator actually goes down. So that really is a combination of things. The third point is that we have a wholesale lending business, and which we used to do at a point in time. We stopped in 2018, and we have some NPAs in that, which we need to clear out. So that really is the combination of three things which constitute our GNPA.
Thank you.
So I'll just add, sorry, to the query from the lady. See, our loan against property is, as we showed in the slide, the average LTV is in the range of 52 to 53%, which means that it's over collateralized to the extent of 1.9 to 2 times the value of the loan. So sometimes just an optic might be misleading. I think if you dip into the collateral backing that loan, perhaps the picture would be different. Thank you.
Last question. In this age of mobile and digital lending, how digital is Fedfina, and how are you using automation in a big way?
Thank you. It's a good question. To my mind, automation and digital now are table stakes. There is every company in the lending space which uses automation for a variety of reasons: origination efficiency, fraud mitigation, to make better credit decisions, and analytics for product management. Finally, for optimizing your collection effort. We use technology for all these reasons, and we use that quite well. However, you look at our segment is everyday India, the small self-employed customer. So the first point of contact and the origination processes entail a customer visit and a manual assessment of his business. Okay, so that really is our secret sauce and an inherent part of our underwriting process. Now, once the customer is on board, all the interaction is digital. And in fact, 40% of our transactions happen digitally through the Fedfina app once the customer's on board. For our gold loan business, once the customer comes on board and gives us the collateral, he has the ability to repay and draw down money. It's a product that we call DigiLocker that he can use quite effectively and extensively. In effect, we've operationalized, an overdraft product for a very small ticket size kind of a loan. So in a nutshell, we use technology and it is now table stakes. And like I mentioned in my concluding slide, we expect that all the technology implementation that we've done to give us some cost saves and enhance efficiency in the future.
One more question from Gitanjali Khedia from SP Tulsian. The average maturity of assets is 97 months, while the average maturity of liabilities is 25 months. Is this borrowing short term to lend long term?
So that's a good question. You look at the average maturity of the loans, and we had a slide on that in our cost of funds section. What you're pointing out is the contractual maturity of the loans. You look at the behavioral loan profile, we have 1/3 of our book, which is gold loans, which matures in about 4 to 4.5 months. So 1/3 of our assets mature in 4.5 months. Our mortgage loans have an average tenure of about 8 years. Our unsecured loans have an average tenure of 30 months. So in effect, because of this maturity profile, we are borrowing longer than our borrowings are of a longer tenure than the average maturity of our assets, and our ALM or asset liability gap is positive right from the first bucket itself, which means that for every tenor, our average borrowings are much more than our average maturities are more than adequate to repay our borrowings.
So, sorry, I'll just add a little more information on that. Our biggest advantage is the mix of short-term loans and long-term loans in our profile. So, some of the peer group in the housing finance sector borrows short and lends long. Because of our unique mix, and as Anil articulated, the fact that we actually have more inflows than outflows in the buckets, in the shorter buckets, means that whenever there is a liquidity crisis, we are much lesser stressed than perhaps much of the peer group. So I would actually position it as an advantage if you look at the behavioral maturity. Thank you.
Thank you for the questions. Now I would like to invite Mr. Bhavesh Shah, MD and Head Investment Banking for Equirus Capital Private Limited, to make the closing remarks.
Thank you all. Anil, CVG, my fellow BRLMs, and friends from the media, thank you so much for coming over. I hope you had a good, restful Diwali, and it was a very, very, very interactive session. And thank you, Anil and CVG, for giving very fine insights into the operations of the businesses and processes of the businesses that has been evolved over a period of time. I would just like to capture a few points. India, we all know, is on a significant growth trajectory. And what is coming out of that is the huge entrepreneurship that we're all seeing across all sectors, across all places. And I think the financial sector plays a very crucial role in enabling that. And I think it's very easy to lend, but very difficult to get the money back. And I think in this, the companies which are very strong with their processes, the governance, and risk processes, they will turn out to be winners of future. In my view, there's a very rare combination of a private equity as well as a private bank, starting this company, which has laid a very strong foundation. In our interactions with Anil and CVG and the rest of the management team, we have been able to see the kind of confidence we've been able to get from them in terms of how they've been able to run this business, and what we see in future is a phenomenal. So track record has been just outstanding, from a profit of 61 crores in FY21 to a PAT of 180 crores in FY23 and a 54 crore PAT just in the first quarter of this year. We're expecting a very good growth trajectory in the PAT to going forward. In terms of the issue, we all know it's going to be opening on November 22nd, closing on 24th. It's a 1,092 crore issue with a combination of primary 600 crores, secondary of 492 crores. And I would, on behalf of Equirus and our fellow BRLMs and FedFina management and the board. Thank you again for coming over, and I look forward to a very encouraging support from our media friends for this issue and a phenomenal coverage as well. Thank you very much again, and I would request you to join us for a lunch.
Thank you.
Yeah, thank you for coming all. Thank you. Please join us for lunch.